Tip 1. Understand what bonds are. Before investing in bonds, it's important to understand what they are. Bonds are essentially loans that you, the investor, give to a government or corporation in exchange for periodic interest payments and the return of your principal at maturity. Bonds are generally considered safer than stocks, but the risk and return depend on the issuer, government. Bonds are typically safer, while corporate bonds come with higher yields but also higher risk. Know what you're investing in to make better choices. Tip 2. Choose the right type of bond. There are various types of bonds: government bonds, municipal bonds, corporate bonds, and international bonds. Each comes with its own risk and return profile. Government bonds are low risk but offer lower returns, while corporate bonds can provide higher yields but carry more risk. If you want tax benefits, consider municipal bonds. Each type has its. Tip 3. Know the bond rating. Bond ratings are important indicators of the risk associated with the bond. Ratings range from A, lowest risk, to D, default. Bonds with high ratings, like the AAA, considered safer, but they also offer lower returns. Bonds with lower ratings, like junk bonds, come with higher interest rates but are riskier. Be sure to research the bond rating before you invest to understand the risk you're taking on and whether the potential returns justify it. Tip 4. Understand interest rates and bond prices. Interest rates and bond prices have an inverse relationship. When interest rates rise, bond prices typically fall, and when interest rates drop, bond prices rise. This is important because if you sell a bond before it matures, the market price could be higher or lower than what you paid for it, depending on interest rate changes. Keep an eye on the economic environment to manage your bond investments better. Tip 5. Watch the maturity date. Bonds come with a maturity date, which is when the bond issuer must repay the principal amount. Short-term bonds mature in a few years, while long-term bonds may take decades. Generally, the longer the maturity, the higher the interest rate, but also the more exposure you have to interest rate risk. Choose bonds with a maturity that aligns with your investment strategy and time horizon. Tip 6. Consider bond ladders. A bond ladder is a strategy where you invest in bonds with different maturity dates. For example, you might buy bonds that mature in 1, 3, 5, and 10 years. This strategy helps manage interest rate risk and ensures that you have bonds maturing at regular intervals. It also provides a steady stream of income while allowing you to reinvest in new bonds as the older ones mature, potentially taking advantage of higher rates. Tip 7. Be aware of inflation risk. Bonds can be vulnerable to inflation. If inflation rises faster than the bond's fixed interest rate, the real value of the bond's returns decreases. Long-term bonds are especially sensitive to inflation because your fixed interest payments are eroded over time. Protect yourself. Consider inflation-protected securities like TIPS, Treasury inflation protected securities, which adjust their principal value with inflation. Tip 8. Know the yield. The yield of a bond is the return you'll earn based on its current price and interest rate. There are different types of yield, including current yield and yield to maturity, YTM. The YTM considers the total return on the bond if held until maturity, including the interest and any capital gain or loss. Be sure to understand the yield when evaluating bonds, as it helps assess whether a bond is a good investment compared to other opportunities. Tip 9. Diversify your bond portfolio. Just like with stocks, diversification is key when investing in bonds. You don't want to put all your money into one bond or one type of bond. Spread your investments across different sectors, maturities, and bond types. This strategy helps minimize risk as different bonds react differently to economic changes. Diversification in your bond portfolio will help smooth out your returns and reduce the impact of any single bond's underperformance. Tip 10. Tax considerations in bond investing. Bonds can have tax advantages depending on the type of bond. For example, municipal bonds are often exempt from federal taxes and sometimes state taxes as well. This can make them an attractive option for high-income earners. On the other hand, interest income from corporate and government bonds is generally taxable at the federal level. Make sure to consider the tax implications of the bonds you invest in to optimize your after-tax return.